Oracle's $10 billion data center deal just collapsed, and the market's response tells you everything about what's really driving these AI valuations. While everyone's focused on the headlines, the smart money is reading the psychological patterns underneath. Today I'm going to show you exactly how human nature creates exploitable market inefficiencies and why this week's action is setting up systematic opportunities for disciplined investors. I've spent 15 years studying how theological anthropology and Stoic philosophy reveal market patterns that most participants miss. The truth is, markets are exploitable precisely because human beings are predictably irrational. When Oracle dropped 5.4% on financing concerns, dragging Nvidia down 3.8% and AMD down 5.3%, this wasn't about fundamentals changing overnight. This was about a psychological mechanism that creates the same patterns across every market cycle. Here's what most analysts won't tell you. The AI trade was never about artificial intelligence. It was about the collective belief that others would continue buying. When that belief wavered, the entire structure unwound, not because the technology failed, but because the financing model was exposed. This is human nature expressing itself through market mechanics, and it's completely predictable once you understand the underlying psychology. Let me walk you through exactly what happened this week using what I call the three-layer framework, and why this creates systematic opportunities for those who remain disciplined while others react emotionally. The human layer reveals the core psychological forces at work. This week, the market was caught between two competing narratives that participants couldn't reconcile. First, the Fed put the belief that rate cuts would continue supporting risk assets. Second, the AI unwind, the growing realization that leverage, not earnings, has been driving valuations in the most crowded trade of the cycle. When Oracle's financing partner walked away from that $10 billion data center deal, it triggered what psychologists call cognitive dissonance resolution. Investors had been holding two incompatible beliefs: that AI infrastructure spending is infinite and that debt-fueled capital expenditures are sustainable. The Oracle headline forced a choice between these beliefs. The choice was exit. This is exactly how crowded trades unravel throughout history, not through careful analysis, but through synchronized fear of being the last one holding. Nvidia, Broadcom, AMD, they all fell in lockstep, not because their business models changed overnight, but because the collective agreement to ignore balance sheet risk dissolved in a single session. Meanwhile, the Federal Reserve delivered its third rate cut with a 9-3 vote split that signals internal fracture. 3 dissents in opposite directions, 2 for no cut, 1 for 50 basis points, reveals a committee operating without consensus. When Jerome Powell calls it a close call, markets hear uncertainty. The dot plot projecting only one cut in 2026 contradicted the dovish action, creating policy fog that prevents conviction in either direction. Here's what's crucial to understand. When central banks send mixed signals, participants default to risk-off behavior in illiquid conditions. This isn't panic. This is pattern recognition. The VIX, rising to 16.5 on declining volume, confirms this. Participants aren't panicking. They're methodically de-risking. Now let's examine the system layer, how these psychological forces translate into observable market patterns. The S&P 500 fell for 4 consecutive sessions, breaching technical support at 6,700. But here's the key insight. The Nasdaq underperformed by 1.81%, while the Dow held relative strength, declining only 47 basis points. This divergence is structural, not random. Large-cap technology, which led the rally for 2 years, has become the source of volatility. Equal-weight indices are outperforming cap-weighted indices, signaling that concentration risk is finally being priced by the market. Volume patterns confirm systematic distribution. The Nasdaq recorded over 3,000 new lows against 1,700 new highs on Monday. This isn't capitulation. This is methodical selling by informed participants who recognize that valuations in AI-related names have detached from near-term cash flow visibility. But here's where it gets interesting. 8 stocks in the S&P 500 hit 52-week highs. On the same day, the index fell 1%. This reveals bifurcation. The market isn't moving as a unit anymore. It's fragmenting along lines of leverage, liquidity, and narrative sustainability. The Fed's decision to resume Treasury bill purchases, $40 billion starting Friday, is quantitative easing by another name. They call it maintaining ample reserves. The market calls it liquidity injection. This creates a contradiction, tightening via rate guidance while easing via balance sheet expansion. The result is a flattening yield curve that signals policy confusion, not economic recession. Sector performance reflects this uncertainty perfectly. Energy outperformed on geopolitical supply disruption from Trump's blockade of Venezuelan oil tankers. Technology underperformed on financing concerns. Healthcare gained 1.3% as defensive positioning increased. This rotation into defensives isn't a trend. It's a hedge against the most leveraged, most crowded positions within growth. Even Micron's earnings beat, with revenue guidance of $18.3 to $19.1 billion versus $14.4 billion consensus, couldn't lift the broader semiconductor complex. The market is no longer lifting all boats. It's rewarding execution and punishing leverage. This is the transition from a liquidity-driven rally to an earnings-driven grind. Here's the Stoic interpretation that creates actionable opportunities. The market is teaching the same lesson it always teaches. Certainty is expensive and crowds are fragile. Oracle's data center deal collapsing isn't a black swan event. It's the predictable outcome of building infrastructure on borrowed capital in a rising rate environment. The Fed's contradictory policy reveals an institution navigating without a map, which is normal, not exceptional. Our job as systematic investors isn't to predict what the Fed will do. Our job is to price the range of outcomes and adjust exposure accordingly. Those who demand certainty from central banks will be disappointed. Those who prepare for multiple scenarios will prosper. The rotation from mega-cap tech into equal-weight indices, from growth into defensives, from leverage into cash flow, isn't a signal to abandon risk. It's a signal to refine risk. The market isn't rejecting technology, it's rejecting valuations that assume infinite liquidity and zero cost of capital. Companies that generate cash, maintain balance sheet discipline, and execute on tangible milestones will outperform. Companies that rely on narrative, momentum, and external financing will underperform. This isn't a prediction. This is a description of what's already happening for those disciplined enough to observe without emotional attachment. This week's action isn't a crisis. It's a repricing. The S&P 500 remains up over 14% year-to-date. The Nasdaq stays in a structural uptrend despite 4 consecutive down days. What changed isn't the direction, but the distribution of returns. Concentration is giving way to dispersion. Momentum is giving way to fundamentals. Liquidity is giving way to scrutiny. These transitions are uncomfortable but necessary. They separate participants who understand process from participants who chase outcomes. The path forward isn't about predicting the next Fed move or the next AI headline. It's about maintaining exposure to quality, managing position size relative to volatility, and recognizing that markets never move in straight lines. The participants who survive cycles aren't the ones who avoid drawdowns. They're the ones who remain solvent through drawdowns and positioned for the next expansion. The market doesn't reward conviction, it rewards discipline, and that difference is everything. If this framework for reading market psychology resonates with you, subscribe for more systematic approaches to exploiting human nature in markets. Share this with someone who's been caught up in the AI narrative without considering the financing risks underneath. The crowd reacts emotionally. We remain disciplined and profit from their predictable patterns.